our goal at Rev is to educate our investors, and we have multiple ways that we do that. One of the most efficient ways that we found is to do it through these webinars. So appreciate you joining us. We'll bring in different guests on different topics, and really looking forward to our guests that we have today. If you've been with us before, then you're familiar with this process. If not, if you have questions, especially today, we're going to be talking about a lot of data, a lot of market analytics, a lot of trends. Please put those questions into the chat box so that way we can address them. And I've asked Connor, as we're going through, before we're changing sections or topics, that we open it up for Q&A along the way, because it is a lot of information. It's going to be like taking it through with a fire hose. So take from it what you will. I hope that you all have notepads or something open next to you to take notes, because I'm telling you, we had the opportunity to listen to Connor a week or two ago at a meetup here in Phoenix. And as soon as I heard him presenting this information, I was like, we've got to get him on. We've got to get him on our webinar. So Connor, thank you so much for taking time and joining us this morning. My name is Dallin Schultz. I'm the president at Rev Equity Group, and we focus on apartment syndications and funds. So without further ado, Connor, let's go ahead and turn the time over to you. So why don't you take a minute, introduce yourself, and then we can get right into it.
Sure. Thanks, Dallin. I appreciate you inviting me to speak. I'm very excited to be here with everyone today. As mentioned, my name is Connor Devereaux. I am CoStar's Director of Market Analytics covering Phoenix. So what that means is that I am responsible for looking at trends in the apartment, retail, office, and industrial sectors. And although those are the four property types that I'm responsible for, the one that by far dominates my time and attention is the multifamily industry in Phoenix. There's a tremendous amount of interest in that property type in this market. And I'm very excited today to be sharing some of the things that CoStar is tracking in this market and where we think things are going from here.
And Connor, why don't you take a quick second, because there's some people on here that may not be familiar with what CoStar is.
Sure. Yeah, of course. Okay. So CoStar Group is a commercial real estate data platform. It includes it tracks apartment, retail, office, industrial, self-storage, every commercial real estate property type you can think of. We have a team of data researchers who are calling out to properties and collecting information about their rents, their occupancy. We're tracking every sales comp in the country. Every time there's a transaction, we have researchers who are automatically trying to capture the information, and we built a database of sales transactions. And it's a tremendous resource that people in the commercial real estate industry use to do their market information, to source their leads. And we have a tremendous sales team here. If you have any interest in CoStar, feel free to please reach out to me, and I can connect you with one of our fantastic account executives.
Excellent. Thanks for sharing that. So in short, CoStar is the leader for commercial data analytics. So very, very fortunate to have Connor with us today, because he's going to do a heck of a lot better job explaining all these market trends and data than I would. So really appreciate you being on with us. So with that, well, let's jump into it. You should have the ability to share your screen, Connor, and we can get after it.
I do. Let's see. Is everyone able to see that there?
Yes.
Great. So quickly, I know I mentioned my bio a bit, but as a recap, I spent 7 years with Marcus and Millichap's Research Services Division. They're one of the leading commercial real estate brokerages in the nation. I've spoken at industry events, webinars, investor meetings like this, and I'm responsible for developing the market narratives for all of Arizona. So that includes Phoenix and Tucson across multifamily, retail, office, and industrial. So before we get started, I'll just sort of do some stage setting about some of the topics we'll be discussing today. First, we're going to look at some of the economic and demographic drivers that are supporting the multifamily industry in Phoenix and why I think it still has a positive long-term outlook. Next, we'll look at how the multifamily sector is in a period of transition. It's been a very dynamic market over the last 12 to 18 months. Anyone who's been closely following the industry has seen the roller coaster ride that we've been going on over the last 12 months. And we're in a very different market than we were last year. Next, we'll look at how persistently high inflation and economic uncertainty is shaping the performance of multifamily. Finally, we'll look at the status of current renter demand, rents, and rent growth, and then our forward-looking forecasts for where we see those going over the next few years. And last but not least, we'll look at the supply that is coming online. Phoenix has a tremendous construction pipeline, one of the most aggressively built multifamily markets in the country. Most of that is focused on 4- and 5-star product, and we'll talk about how that's going to impact things here over the next 12 to 36 months. So first, the economic and demographic overview. One thing that I like to point out is that Phoenix was one of the strongest performers in terms of the labor market recovery from the COVID recession. As you can see here, we're comparing the job losses and then subsequent recovery of jobs from Phoenix to the United States. And it becomes clear that the downturn that Phoenix experienced, the red line here, did not go as sharply declined as the United States did, and it recovered much faster. That trajectory was a more rapid slope. So as a result, Phoenix lost 250,000 jobs in 2 months and then recovered all of those jobs in 17 months. And that's a full year ahead of what happened to the United States, where it took 29 months to recover all of the jobs lost on a national scale. And when you look at where we are now, that red line is we've added over 100,000 jobs than we did before the pandemic. And the strength of the Phoenix economy during that time, people were moving here like crazy. Companies were relocating and creating jobs. And because of those factors, Phoenix was really well positioned to recover from an economic disruption like this. When you compare that to the global financial crisis in 2007, 2008, that's the chart here on the right, it becomes clear that during that period, Phoenix was hit harder and it took longer for the labor market to recover. So that red line on the right-hand chart here was almost twice as far down compared to the US in the blue line. And it took over 18 months longer to recover all of those job losses. And what I love about putting these—
I'm sorry, Connor, not to interrupt. I want to touch on that real quick because it's not news that Phoenix was one of the cities that got hit the hardest back in 2002, 2007, 2008. So initially that led some people to be a little weary of investing in Phoenix because of how hard it got hit. But this is really what happened, just so some people have some history. Back in 2007, 2008, the industry was built and tied to rooftops. It was tied directly to real estate because so many people were moving in to the city. So when the real estate market crashed, all those jobs went away, and that's why it got hit. So what Arizona did, they came together after that and they said, hey, we're the laughing stock of the country, right? We can't go through this again. How do we make it better? So they had a meeting of the minds. They came together, said, okay, what do we need to prevent that from happening again? We need more jobs. We need more jobs. We need more companies coming into Arizona to mitigate that risk. So over the last 10, 15 years, that's exactly what's been happening. And we are seeing that today. And you'll probably touch on this a little bit too, Connor, but we have tech industries come in. We have healthcare coming in. We have so many more businesses moving into Arizona and Phoenix specifically, and Tucson. So now the real estate, that the industry, the market isn't just tied to rooftops. It's not just tied to real estate. Now the real estate is in demand because of these other jobs that are bringing people in. So a much healthier economy for Phoenix and for Arizona. And these two charts show that difference. It shows what happened because of the changes that Arizona made. So just wanted to point that out real quick.
Yeah, and you're absolutely right. What I love about comparing these two charts is it becomes the diversity of the Arizona economy is very clear. We've done a tremendous job of not being overly reliant on a single sector like we were with housing. And that's just added to the strength of this market. And the other thing that was strengthening the market is the tremendous demographic tailwinds that we've had. So Phoenix here is the #4 market in the country in terms of job growth. We're up there with some of the, high growth, smile, Sunbelt states with Austin, Florida, the Carolinas, Texas. All of these markets benefit from similar demand drivers where we have an affordable cost of living. We've been leaders in job growth. The quality of life is very attractive because we have 300 days of sunshine here in Phoenix, that sometimes in Midwest markets, they don't get that in 3 years. And because of those factors, people are moving from expensive, dense coastal markets into Phoenix and other metros in the South and to the Southwest. Similarly, the Midwest, as people are fleeing the job prospects and climate coming to the South, and these have been the big winners. And on the right, you can see, as I mentioned, dense coastal markets, Midwest have been the losers here on the right. And so all of that job growth and that diversity of employment has been fostering a new Arizona growth economy. So anyone who is born and raised in Phoenix is very familiar with the 5 C's of Arizona. For some reason, this was drilled into everyone's head when they were in middle school, that Arizona has cattle, climate, copper, citrus, and cattle, or there's another C I can't even remember. But what I've come up with is the 5 S's of the new Arizona growth economy. The first one being semiconductors. So TSMC's $40 billion investment in North Phoenix to build a pair of semiconductor manufacturing plants has been a tremendous win for the state. The investment, local officials have estimated, could bring up to 45 other companies into Arizona to support and supply the project. And the knock-on effects of an investment of that size are tremendous. Supply chain. So the West Valley, and specifically, has become a key link in supply chains nationally. And the warehouse, distribution, and logistics segments are outperforming in those areas. If you drive along the Loop 303 today, you'll see a tremendous amount of large, big bomber industrial spaces being built. And Phoenix is really establishing itself as an important hub for distribution. Next, sustainability. We've become a leader in advanced manufacturing. This ties also to semiconductors, but things like electric vehicles, batteries, solar are all growing. And these are all jobs that support high wage professionals that benefit the economy as a whole and the apartment sector. Similarly, aerospace. So we've already been a leader in aerospace and defense with Raytheon and others, but also we've seen Blue Origin and Virgin Galactic. These are private space companies, are building rocket ships here in Phoenix. And then finally, I had to cheat a bit. I hope you all forgive me on the call, but science has come alive here. So this is biotech and medical devices, the Phoenix Bioscience Core in downtown Phoenix, and our local universities have been investing millions of dollars to support the life sciences industry. And that's been an emerging sector that I think is going to grow moving forward. So in wrap up here, when I think about the trajectory of the Phoenix economy and where I think the growth will be coming from, I suspect that it'll be these 5 sectors here is where you're going to see a lot of the gains. And so before we move on, Dallin, were there any questions about the economic and demographic situation here in Phoenix before we jump into multifamily fundamentals?
As a reminder, you're welcome to put it in the chat box, or you can just unmute and pose the question before we move on.
What about the political environment in Phoenix and the economic impact from taxes and whatnot? Do you factor that into your decision as well? Because jobs come with companies. Companies don't come with jobs, don't follow the jobs. And so are we in a tax favorable environment here in the Arizona area?
Yeah, absolutely. So one of the factors driving the corporate relocations and organic business growth that the city has seen has been the favorable regulatory climate. I know I can speak specifically to data centers. So Phoenix is becoming one of the leading data center markets in the entire United States. And a lot of that has to do with tax breaks and favorable treatment for data center operations. And because of that, people are building, Facebook, Apple, et cetera, are building data centers here that are then creating jobs. TSMC is another great example. I know Governor Ducey worked with officials with that company to entice them to work here. And I think the tax situation and entrepreneurship focused environment absolutely is supporting the types of.
Yeah, the utility rates are favorable as well. These corporations, data centers are highly dependent on electricity. And so our electricity rates compared to our competitors to the west are very favorable for them.
Yeah, and the other thing I've heard is the stability of the power grid is very attractive for these data centers. And then we also have a more mitigated risk to natural disasters, which disrupt their operations.
Connor, are you saying, well, I mean, we haven't, I think this was back in towards Thanksgiving and the holidays. I heard California was asking all their residents not to all charge their electric cars at the same time because the grid just couldn't support it. So these are things that aren't often talked about too much, but that need to be considered when developing a state and then an economy. So Beck, I appreciate you bringing that up. And Beck has a lot of experience in the utility space and the power space, so he has some insight there.
Great. Any other questions? Okay, I think with that, we'll move on to the main event and take a look at what's going on with the Phoenix multifamily market. Okay, so one of the first things that I like to focus on is search activity on apartments.com. So one of the great benefits about working for CoStar is that we own apartments.com and tons of other online renter platforms. And because of that, we get access to data from behind the scenes. So we get to look at what's going on with search activity on that platform, which is the #1 rental portal in the US. And you can see that the red line is 2021. And look at how strong of a performance the market saw in 2021. That was search activity was elevated well above what we saw in 2020 levels. And as a result, we saw very, very strong renter demand. Compare that to 2022, we saw at the beginning of the year, the first quarter, search activity was elevated. And then through the summer, it started to decline. And then through the back half of the year, it was below even 2020 levels. And that we really saw that play out in the supply and demand metrics, where supply and demand growth weakened through 2022 compared to 2021, which was such an outstanding year. I do want to sort of make a note that these types of indicators don't always translate directly into apartment demand. It's more of a leading indicator that I like to keep tabs on. And looking at it, in 2023, we only have about a month of data here in early February. It's on pace with 2020 levels. It's below where we would have been in 2021, but it's not much lower than the beginning of 2020, which was before COVID really hit. And it looks like we're on track for that. And then as you see how that translates into the supply and demand metrics, it becomes clear 2021 was such an outstanding year for Phoenix rental demand. The red bars here are net absorption. This is the amount of new units that are being occupied every period. And in 2021, the red bars well outpaced the gray bars, which are the new construction. And because of that, we saw vacancy rates compress considerably, and they bottomed out at an all-time low of around 5.5% in the summer of 2021. And because of all of this tremendous momentum in the multifamily market, developers responded, and we now have one of the most aggressive construction pipelines. And the new supply began to come online in 2022, which are those gray bars there, and it overwhelmed Phoenix rental demand. And at the same time, we saw renter demand actually pull back. So 2 of the last 5 quarters, we've had negative net absorption. So more people are moving out of apartments than are moving in. We'll get to why I think that happened in a minute here, but that supply and demand imbalance caused vacancies to increase dramatically in 2020. We saw rent growth slow. I also want to point out that I have a bit of a pet theory when it comes to why I think some of this could be happening. I think that there's possible that some of the demand that would have naturally materialized in 2020 was sort of pulled forward into 2021. And because during 2021, if you remember, vaccines were being distributed, fiscal stimulus was flooding the consumer. There was a lot of optimism in how things are going. And because of that, I think there are some people that may have made one of their leasing decisions ahead of time. And that's sort of artificially pushed up demand in 2021. And then in 2022, we saw sort of the hangover of that. And as we look forward, we're still expecting that tremendous amount of construction to outpace new rental demand through 2023 and 2024. We have vacancy rates peaking at around 13.5% in 2024 before improving in 2025 as the new supply wanes. And so here's the big question. This is the number one question I get by far, and it's, why is Phoenix renter demand moderating? What happened? Where did all the renters go? And I think it can really be tied to 2 main things. The first is high inflation. So Phoenix is a leading market in the entire United States for inflation, which itself is at a near 40-year high. It's coming down, but inflation was very, very high over the last year. And because of that, potential renter households, this is the marginal renter, is feeling their budgets being squeezed by inflation. So grocery prices are going up, used car prices, gas, et cetera. All of those factors have made it difficult for the new renter to execute a lease. And from my conversations with property owners and managers, what they're not seeing is that the existing in-place tenant is being overly squeezed by high rents and are now doubling up or moving back home. It's more about the demand walking in the front door is where they're seeing weakness. So this is people that maybe graduated in 2022 from college. They've been working, but because their wages aren't keeping up as quickly as inflation, they're not feeling as comfortable about moving out and signing a lease. Similarly, you can look at the Consumer Confidence Index by the Conference Board, which measures how consumers are feeling about their economic situation. And it becomes clear that it's been on the decline with all the talks of recession and the Fed hiking interest rates to tame inflation. Folks are feeling insecure about their economic situation. And when that's happening, they're less likely to make large decisions like moving across the country and renting an apartment, or moving out of their parents' house and signing a lease, because they're not sure if they're going to have a job in 6 months, because the news media has been talking about layoffs and the Fed is on this path to tame inflation. And that's shown up in our rent growth numbers. And you look here on the left, this is a daily rent growth series, which I absolutely love. What you can see first that jumps out to my mind is how strong 2021 was. It was an outstanding year in terms of rent growth. If you look at the gray bar compared to the blue bar, which is 2019, it becomes clear how unprecedented the rent growth was. We saw rent growth top out at around 24% year over year in parts of 2021. And because of that, apartment owners, ooh, my light just went out. 1 second, let me try and get it back on.
On that note, while he's looking into that, this is incredible data, and it's important to understand and see how it impacted things here in Phoenix. So we run into this all the time. You find the average, and you're probably going to talk about this coming up here, Connor, but average sale price right now in Phoenix, you're looking at $250,000 to $300,000 a door for a multifamily property, multifamily unit. You compare that to something in Texas, and you might be looking at $160,000 to $180,000, maybe pushing $200,000 a door, right? Depending on the asset class. So couple things, like this is what drove prices in Phoenix so high. And those that invested in Phoenix made out like a bandit these last 2 years because there was two things happening, right? Really low supply. We had these causing high rents. And then on top of that, Arizona is one of the states that has the lowest, in relation to other states, low property taxes and low insurance. And so when you factor in all these things and you can increase rents at the rate that it did, it forces a much higher sales price. So people were buying high, but they were also selling high, and it was compressing those cap rates. That coupled with very, very inexpensive money. I mean, people were borrowing at 2-3% for these multi-million dollar properties. All those things combined together created this perfect storm for people to just crush it these last 2 years, and not just in Phoenix, but really across the country. And what we're experiencing now with the Fed increasing rates, in fact, they just increased it again another 25 basis points. That's their way of correcting what's been going on these last 2 years. If you got invested in real estate in the last year or two, accept it for what it is, appreciate it, but understand that that's not normal. And so what we're seeing on our end, and what we're having a lot of conversations with investors, and why we do these webinars, is that there's going to have to be this re-education, if you will. We got to reset those expectations, because if you got started a year or two ago, your expectations are up here, and that's not normal. And so this data and this stuff that Connor's sharing is it all plays into the bigger picture and things that you want to be aware of if you're getting invested in multifamily or real estate in general.
Absolutely. Yeah. 2020 and 2021 were unprecedented for many reasons. And the performance for Phoenix apartments is no exception. Even if we've seen rents decline, that's the yellow line here, through the summer of 2020, and then it started to decline in earnest throughout the back half of the year, and it actually ended the year negative. But even with top line rent growth declining, if you participated in the rent growth run up that we saw over the past couple of years, you're still 12% ahead of where you would have been according to pre-COVID rates of growth. So a bit playing with house money. Another way to look at rent growth here, in 2020, you can see that bar turn negative. Rents declined 0.5% to finish the year. But look at how strong that growth was in 2021. Very, very aggressive rent growth. But moving forward, we're anticipating that weaker renter demand combined with a very elevated supply pipeline is going to have tepid rent growth through 2023 and 2024 before re-engaging in 2025. I do want to point out that this is for average asking rents. So this is new rents for folks who are signing a lease for the first time. I've heard different stories about in-place tenants and renewal rates. And I've actually heard that that's been a great source of growth for a lot of folks, is by making a concerted effort to mitigate the loss to lease on existing tenants. And while all this is happening, construction is very, very elevated. Phoenix has a very aggressive construction pipeline. This chart on the left shows the run up in the units under construction. We currently have about 28,000 units under construction in Phoenix, the majority of which are 4- and 5-star luxury renter class product. And because of that, I suspect that there's going to be a bit of an imbalance when this stuff comes online, because these developers are all targeting the same piece of the renter pool, that renter by choice, 6-figure young professional renter, and they're building these luxury resort style apartments. And I'm curious how well they're going to lease up. We'll find out more here in the next 12 to 36 months, but we've already seen weakness among that Class A segment. The good news is that it looks like it's peaking, that now new demand or new supply should be moderating. We also track construction starts. So this is how many units have broken ground every quarter. And they fell off a cliff in the second half of 2022. I heard a lot of this was driven by the increase in interest rates. So now that developers, when they are putting together their models, the exit cap rates on their developments have increased between 150 and 200 basis points. So it is not as profitable to break ground, because when they eventually sell the asset, they're delivering into a very different interest rate climate. And that's what helped tap the brakes a bit on new construction starts.
And I appreciate you bringing that up, Connor. And this is this is why at Rev we really like to focus on what we would consider that B class asset. These are properties that were built 15 to 20 years ago that were these class A's, right? These were the ones that were being completed right around 2008, 2009, 2010, right? So we like taking those because they're what we consider first generation rehabs, remodels, meaning oftentimes not much has really been done. So we have the existing property, we can see the performance, and it's quicker to implement the business plan than going in with a full-blown brand new multifamily development. Not to mention the market and everything changes so much. So when you start your analysis with a development 2 years from now before it's actually complete, it's hard to gauge and know what that market's going to be like. And you do your best to project it out, but we like to get into existing properties because there's already a proven concept. There's a track record that we can easily get in, implement, move out. So that's why we like that B class. C class, you're looking at more your 1980s, and there's some operators that do very, very well there, but it might require a little bit more work. So that data and that information Connor shared is exactly why we try to avoid the class A's, because if you can't get those rents, it's going to soften because they got to lease up. They got to get tenants in there. So if you're not getting the rents that you were projecting, you're setting yourself up for significantly cutting into your cash flow and return. So appreciate you sharing that.
Yeah, absolutely. And then when we look at geographically, where is construction taking place? I love this heat map on the right. It does a great job of showing where the hot spots are in the valley. So unsurprisingly, downtown Phoenix, which has gone under a tremendous transformation here over the last decade, is getting the bulk of new construction. Additionally, Tempe, which has some similar demand drivers. It's where it's young people want to live, and there's walkable amenities and restaurants and bars, and they're kind of the cool areas where young people want to live and are moving. They're also job growth centers. And for that reason, they're both receiving a tremendous amount of supply. Midtown, just above downtown, also getting a lot of construction as competition in the CBD heats up. People are starting to drift further and further north, and Midtown has seen a lot of construction. But what also strikes me is just how widespread development has been. Throughout the West Valley, you're seeing construction peppered in those communities. East Valley, same thing. From what I've seen, the West Valley has been getting a lot of build to rent product. That's single family rental horizontal apartments. Seems to be an attractive development option for developers. And also at the top of the map, that blob there is where TSMC is building their $40 billion manufacturing plant. And developers are already going in with anticipation that it's going to create additional renter demand. And because like Dallin has mentioned, and I mentioned, a lot of the construction has been focused on Class A 4 and 5 star product. 4 and 5 star is how CoStar rates properties. So it's kind of like our version of Class A. You can see that vacancy rates among 4 and 5 star have increased the most compared to their pre-COVID level. So the yellow line here has climbed 270 basis points from 2019 Q4 compared to just 80 basis points for 1 and 2 star. And as that new construction comes online, I suspect we'll see further imbalancing if they're not leased up quickly enough. And because of that, property owners have been increasing their concession usage. This is number of share of properties offering free rent to entice lease activity. You can see that it's happening nationally. That there's been an increase across the board in terms of concession usage as rent growth and renter demand has moderated. But it's especially prevalent in Phoenix, which has had one of the swiftest reversal of fortunes and one of the most aggressive construction pipelines, which intensifies demand. So with that, Dallin, I've come to the end of my presentation here. I have 5 key considerations moving forward. Is there anything else you want to touch on before I kind of wrap things up?
I think that was great on my end, but I think would this be an appropriate time for some Q&A for you, Connor, or were you wanting to wrap up the presentation and then we jump into that?
Yeah, why don't I wrap up here, and then if anyone has questions, feel free to either put them in the chat or speak up, and I'll do my best to answer.
Excellent.
So the first thing I want to reiterate, I know a lot of the stats in this presentation were a bit negative in terms of the status of the Phoenix apartment market, but I want to reiterate that the long-term drivers supporting multifamily in Phoenix are still in place. We have tremendous job growth and economic diversity. We have strong demographic patterns with people moving here. They want to live here. And we have strong affordability, attracting businesses and people, which all are good tailwinds supporting the multifamily market. That being said, that this year will likely feel a lot like the second half of 2022. So in the second half of 2022, we saw more tepid renter demand. We saw rents declining for much of the year, and all while supply was hitting a record level. CoStar's base case forecast is now calling for a mild recession in 2023, which will further weaken renter demand, and we suspect that the performance will be tepid through much of the year. As mentioned, slower renter demand, weaker rent growth, more concessions are going to be here in the near term, and monitoring your supply pipeline will be increasingly important. This is always important, but especially in periods where rent growth is moderating and supply is peaking, understanding what's going up in your 1, 3, and 5 mile radii becomes increasingly important to know what types of properties you are up against when you're competing over tenants. And then finally, this is something I mentioned already, but because the weakness that most of the rent growth or rent demand has came from is new demand walking in the door. I've heard from one property owner that over the last 180 days, they've really made an effort to push renewal increases on existing renters, because during the run-up of rent growth in 2021, those folks did not get their rents benchmarked to market rate as quickly as a new person walking in the front door. And as a result, they're viewing their in-place rent roll as a source of growth moving forward, particularly as new renter demand is starting to weaken. So with that, Dallin, I'd like to just thank you for inviting me to participate. My contact information is here on the screen. If you have any questions, please feel free to reach out to me. I'm happy to share this slide deck with anyone who wants to reach out. And with that, if anyone has questions, I'd be happy to answer a couple here as we wrap up.
Kevin, it looked like you were talking, but you're muted.
Yeah, sorry about that. That was a great presentation. Thanks.
Absolutely.
Are you in the Phoenix market, like living?
Yeah, so I was born and raised in Phoenix. I live in Midtown. The CoStar office is here at the Biltmore.
So, like, from what you just said and displayed, what's your feel for the market itself?
So what I think, my feel is that I think that there's still a lot of strong demand drivers for the long-term outlook. I'm a big believer in the value proposition that Phoenix has, but I think that we're going to feel some pain here over the next year with the amount of supply that's coming online, just as rent demand is weakening. I think there's going to be a bit of a dislocation there, particularly if the economic recession that we're anticipating is worse than expected. I think there's a possibility that a more severe imbalance could occur.
So the other thing is, like, the $60,000 question is, like, you always hear about the water supply. I think you would have a better judgment on that, being there most of your life or all your life.
Yeah.
And, you always hear it seems like every week I'm getting bombarded with things about the water. Like just recently I heard a city just outside of Scottsdale
Mhm.
was shut down completely from the water source from Scottsdale itself. They had an agreement with them. Did you
Yep.
hear anything crazy like that?
Yeah, yeah. I think it's called like Mesa Verde or something. It's a community that was outside of Scottsdale's city boundaries, but relied on the municipality for their water supply. And then now that they've had a disagreement, and I think Scottsdale is more focused on serving their residents, they potentially weren't serving them anymore. I think one thing to keep in mind when we talk about the water situation is that the vast majority of water is for agricultural uses. I've seen different numbers, but it's something like 70% of the water consumption is not, people watering their front lawn or commercial uses at, big factories. It's, growing agriculture. So because of that, I've heard some estimates that we're actually consuming less water today than we did in the 1950s, despite all of the population growth that's occurred, because our share of the economy that's focused on agriculture has declined so much. And a lot of these big investment projects like TSMC and other manufacturing, advanced manufacturing uses have excellent water retention services to make sure that they're recycling and maximizing the water that they do get. That being said, what I've heard is that there are, in order for residential developers, not necessarily multifamily, but big master planned single family housing communities, in order for them to be able to break ground, they need certificates of water surety, which means that they need to guarantee that they have 100 years of water supply from their groundwater. And there was one development in the far West Valley that was not able to get that certificate, and then had to put on hold their residential construction. So I could see a situation where the tremendous industrial construction that's going on in the West Valley because of the supply chain and advanced manufacturing, if they aren't able to build enough residential housing because of water issues, there could be a situation where the labor to support those projects isn't there, and maybe industrial developers will pull back until the infrastructure is efficiently built out.
So you think like that city outside of Scottsdale, you think that's kind of like a one-off type thing, or is that kind of maybe something to look into in the future?
I don't know a ton about that specific story. It sounds like kind of a one-off situation to me that just had a perfect recipe to be attractive for news organizations. But I don't know enough about it to really give an effective answer. But I do know that they weren't part of Scottsdale. They were relying on Scottsdale for their water, and then now Scottsdale has chosen maybe not to supply them.
And Kevin, knowing Scottsdale, this is just my thoughts without, again, not knowing too much about it. Sounds like it was more political than anything else. And it wasn't that there wasn't water. And all over the news, you see Lake Mead, right outside on the border of Nevada and Arizona. Lake Mead levels are dropping. They're finding bodies and boats and stuff. That's not where we get our water from. We get a little bit from that, but the majority of water in Arizona is pulled up in the underground retention in the aquifers where we pull from. And so to Connor's point, anyone looking to go in and do a big subdivision, they have to have, I believe, was that 100-year supply? 100-year supply of water before they even get permission to build on that area. So people like finding the things that scare and trigger people and really start talking about it. But at the end of the day, yes, there are systems and things in place here in Arizona to make sure we don't run out of water.
Yeah, they also take it from the Colorado River, right?
Right. And that's what leads into like Lake Powell and Lake Mead. So they do pull from there, but all over the news, you see these water levels dropping. So they're like, oh, shoot, Arizona's running out of water. We're not running out of water.
Yeah, it's like every week you hear something from some other angle. But like, I don't want to take up too much time, but my other thought was like if people might be leaving Phoenix because of the cost, right? Is it kind of like the tertiary markets and the secondary markets that are benefiting, like Tucson and maybe parts north? Do you have any info on that?
Yeah, so I think there's going to have to be a bit of a mindset shift about Phoenix being this affordable market. I think it is still an affordable metro compared to, coastal markets in California, the Bay Area, Pacific Northwest, even like Denver. We're more affordable than them, but we're not the, ultra affordable alternative that we used to be. Rent growth has increased dramatically. If you look at the housing market, home prices are very elevated. I don't think that that's going to necessarily significantly deter in-migration to Phoenix. I think the other factors that I mentioned with strong job growth and quality of life and lower taxes are still going to attract people here, but we're no longer this affordable market. And so, yeah, I guess your question is being, well, where are they going now? Yeah, I think Tucson could be an opportunity for people to benefit from people choosing to live there due to affordability. There could be a situation where folks, because of remote work, were able to work from anywhere and keep their Bay Area salaries. And if there's a dramatic return to work effort, these people may need to leave Phoenix because they were living here because they could work remotely, and now they have to move back home, or they'll simply quit and get a job here. It's kind of up in the air.
Good stuff. Thank you.
And on that note too, Kevin, one thing to keep in mind, we're experiencing population growth, we're experiencing job growth, but the businesses moving in aren't necessarily your blue collar jobs. These are high tech companies. So along with the job and population growth, the overall median household income is increasing as well, which is driving the household value. So it's not, if these things were out of whack or some were increasing while some were dropping, that would be a concern. But the fact that they're all growing together shows a healthy growth happening in the market. And to Connor's point, compared to LA, San Diego, Denver, New York City, Phoenix still is relatively inexpensive. It's just 10 years ago, people knew of Phoenix, but we were flying under the radar, right? Mm-hmm. And we've actually looked at some properties in Albuquerque, New Mexico. And this is my thought. I have no data to back this up. All right. So take from this what you will. I can see Albuquerque, New Mexico becoming the new Tucson, Phoenix in the next 10 to 20 years. And there's already businesses moving out there because they have some property taxes are really low and they have room to build. And who talks about Albuquerque, right? Albuquerque is like that sleeping city in the Southwest that doesn't experience as extreme heat as Phoenix does. So I can definitely see in the next 10, 15 years, you're going to be seeing more growth. More people are going to be talking about Albuquerque. 10, 15 years ago, nobody was talking about Tucson. And now it's one of the biggest markets people are looking into.
So well, now that you mentioned that with a white collar, then, of course, behind them comes the service group, right? So that could be one of the other S's. Now you're up to 6 S's. But the problem I see with that is the affordability thing, right? If you bring all these service people in to support all these white collar jobs, where the hell are they going to live? Probably won't be in the city. It'll be outside. So I don't know. How's the transportation system?
I don't use it that much. Are you talking about for these blue collar jobs?
Yeah, like all the service people, if they can't live in a city, they're going to have to commute like from wherever. And I don't know, like Phoenix being like I'm not sure like if they have a big transportation hub, like as far as trains and.
Yes, Phoenix has the light rail. That's probably our largest public transit option here. It runs from the East Valley in Mesa through Tempe, through downtown Phoenix, and then up north to near Metro Center Mall is when they're expanding it. But Phoenix is generally a commuter market. We have a tremendous freeway system that connects all parts of the valley through a series of freeways, and which are in pretty good shape, all things considered. But yeah, in general, it's more of a commuter city, and people tend to either locate near where their jobs are or out in the suburbs and commute in.
And there's also, on that note, there's also a railroad, an existing railroad between Tucson and Phoenix, and they're talking about turning that into a bullet train route. So you've got, I mean, from Phoenix to Tucson, you're looking at an hour and a half to 2 hour commute on the freeway. So all that land, and it's just flat land, it's flat farmland. So what's going to happen, and we're already experiencing this, as Phoenix starts expanding and Tucson starts expanding, it's pushing people out into these more tertiary markets. However, these tertiary markets are sandwiched between the two largest MSAs in Phoenix. So, I mean, you drive through Los Angeles, you drive through Boston, New York City, it's just one continuous city. Give Arizona 20, 30 years, and between Tucson and Phoenix, it's going to be one continuous city. So the good thing is that we have area to expand. So naturally, as cities start expanding, businesses moving in, yes, it pushes the service industries out, but still within 30 minutes, there's a small country town that we're developing in. People will buy a home there a few years ago for $200,000, and they drive 30 minutes north and they're in Chandler working at the Intel plant. So like things are still relatively close, and being able to provide for those different industries and services.
Yeah, I've heard the same thing, Dallin, in regards to like Pinal County as an opportunity from industrial developers specifically. The land is cheaper and it's more affordable than, you know, maybe the east parts of the East Valley. And I've seen some suppliers for TSMC decide to operate there. I know Changchung is an example. They make industrial grade chemicals for semiconductor manufacturing, and they're building a plant in Pinal County. And then there's also some operations with electric vehicles. Nikola, I believe, it has a plant there as well. So I could see that area as an opportunity for like manufacturing and supply chain growth.
Sure. Connor, we have a question here. Somebody's looking in South Carolina area and is wondering if there's data available for that specific area, more so in the Myrtle Beach. And
yes.
If so, how could they get a hold of that?
Yeah, so I'm the director of market analytics, CoStar director of market analytics for Phoenix. There are, you know, my counterparts across the United States in every major metro. I actually know the person in South Carolina. He's an excellent analyst and very knowledgeable. If you're a CoStar subscriber, you could get access to data across all markets in the United States. And it's an incredible resource if you want to do that type of research. I don't have any data specifically on hand for Myrtle Beach, but you know, I can happily connect you with a CoStar account executive who might be able to get you some numbers or show you about the platform.
Did that answer your question, Rob?
Maybe not the answer he was looking for. Apologies. Yeah.
He said that would be great. Thanks. So, Connor, if you could provide some of that information, that way we can share it, that'd be excellent.
Will do.
So, excellent. Well, we got just a couple minutes left. We got time for one more question. Kevin, thank you for your questions, by the way. That was excellent. Excellent conversation. All right. Connor, thank you so much, man. This was a lot of useful information. Hopefully y'all took pictures and took some notes. Connor, if you wouldn't mind emailing me that presentation, we can send it out to our entire network and have your contact information on there as well.
Will do.
We actually do have one more question that came up real quick. What's the current cap rate for multifamily properties? And to clarify, are you asking about the Phoenix market? Yes.
So
what are we looking at for cap rates?
Yes. So Dallin, you actually might be a better source of information for this. You're looking at deals individual deals more frequently. We have a cap rate series, which estimates cap rates for every property in the market. And I'm seeing that in the like low 4% range, around 4%, which has increased, you know, here in the last, it's ticked up. Cap rates have drifted up definitely over the last 6 months as high interest rates have raised the cost of borrowing. But what I'm still waiting for is to see more sales comps of, you know, higher cap rates. I don't know, Dallin, what have you seen in regards to that type of thing?
So we haven't looked at too many properties here in Phoenix because there's a couple big buyers here, and we'd rather partner with them than compete with them. Our most two recent acquisitions were actually in Houston, but to your point, from the little bit we have looked at, 4 to 5% is still what you're looking at, even with interest rates increasing. And the reason being is because sellers are still hanging on to that compressed cap rate that we were experiencing for the last year or two. And so to Connor's point, I feel like we need more time over the next 6 months to see a few more transactions come through to really know kind of where we're at. And the Fed keeps hiking rates. They're talking about hiking at another 25 basis points. So we're in this weird zone where buyers and sellers are still trying to work together to get deals done. But I wouldn't say we have a new norm yet. I think everyone's still trying to figure out what that is.
Yeah, certainly. The period of price discovery is how I've heard it described, where sellers are still like kind of anticipating the investment climate that they had, you know, at the peak of the market 12 months ago ish. And buyers are not as willing to pay up for those types of assets with such high cost of capital and then the weaker property performance projections. So that spread between buyer and seller expectations, I think, is wide, and it's going to take, you know, loans coming due where folks are going to have to either add capital to their property to secure permanent financing or sell. And then once those transactions start to take place, it'll sort of reset the market. And we'll see where we're at then.
For sure. There's definitely going to be some opportunities coming up. Right.
Absolutely.
So, well, folks, thank you so much for tuning in to another Rev Real Estate Live. Again, my name was Dallin. I'm the president of Rev Equity Group. We want to partner. We want to partner on deals. We like partnering with investors, but first and foremost, that alignment has to be there. I shared a little bit throughout this call the types of assets and projects that we focus on, but we want to get on a call. We want to talk to you, see what your goals are, to see if there's even alignment there before we start talking about doing a deal together. So if that is something of interest to you, go to investwithrev.com. That's our website. And in the top right corner, there's a little button you can push to schedule a call. We'll just jump on it and see what you're looking for, let you know where we're going and see if it's a good fit. So thank you so much for coming out. Connor, again, thank you so much for this information. We do send out these recordings. So they come out Tuesday morning. So keep an eye out for that. And in that email, we'll also include this presentation so you can refer back to it. And again, it's for the Phoenix market, but it at least shows you things to look for in other markets. And there were some excellent lists in there showing what markets were experiencing inflation the highest, population growth, so you can still identify healthy markets from that data that Connor shared. So awesome. Thanks so much for everyone for coming out. Connor, thanks again. Appreciate it. And looking forward to connecting with more of you. And we'll see you next week. Next week, we are going to be talking about cost segregation, the sexiest tax savings you can receive in real estate. So we have a guest coming on to talk about that, to teach us and you how you can save money on taxes by investing in real estate. So thanks so much for coming out, and we'll see you all next week.
Thank you.